So what cliches should we need to hear in the new year? We have Cole Smead, Smead Capital Management CEO, and Matt Maley, Tabak Managing Director and Equity Strategist. Cole, let me get over to you. Which market mantra do you think may work pretty well next year?
Well, thank you. I think the idea of don't fight the Fed, what really markets have been swinging around on is the futures markets, right? What the futures are expecting has been really what's moved markets around. So the future, use this year, the futures are betting that we're going to wake up on lower rates, on the short end of the curve, and thus, ultimately on the long end of the curve. And my only problem with that, or our only problem with that whole mantra, is that it's been a terrible place to bet with for 2 years. They've been wrong for 2 years. So we find it interesting that people have, in effect, fought the Fed. The Fed stayed fairly tight relative to history and in a very aggressive way. And stock investors think that will not affect how people look at things. And so we just think that's kind of fantasy land. We think that mantra is going to hold true. And anything short of the Fed waking up, over 400 basis points on short end of the curve, we think equity markets are really going to be hamstrung by that.
Matt, I want to bring you into this as well. The mantra that kind of stands out to you the most over the course of this year, and what still holds true going into 24?
Well, this whole thing that Paul was just talking about is something I totally agree with, is that, we don't want to fight the Fed, but number one, the Fed has only stopped raising rates. They haven't actually started cutting yet. But more importantly, I think what the markets are doing right now, in the futures markets that they're following, is pricing in a return to the free money era. And I just don't see that happening. I mean, interest rates have come down quite a bit, obviously, in the last 2 months, but they're still much, much higher than they were in 2021 and way higher than 2020. And so this thought that we can go back to those, kind of crazy valuations of 20 times earnings. And my thing is, I look at price to sales even more, because you can fudge earnings a lot. You can't fudge sales. And we're 2.6 times sales now in the S&P 500. And except for 2021 and the very beginning of 2022 when it started falling, it's never been this overvalued. So we're going to have to see a big improvement in the economy next year, a big improvement in earnings, a lot more than the consensus is looking for right now, for the market to do a lot better. So, not fighting the Fed is a good idea, but, until they really start cutting rates, and unless they cut them dramatically, which I don't see them doing, unless there's a crisis, which will cause other problems, I think that I agree with Paul with what he's saying.
Cole, if one is inclined to not fight the Fed again next year, what trades work best, do you think?
Well, just to give you an analogous period, this looks a lot like 1972. Just to take everybody back, there was a bear market coming off the late 1960s. It wiped out the average equity investor. Let's just call that 2022. And then you had a pickup in the Nifty 50 to the peak in December of 1972. That's what we're having. That is the Santa Claus rally that happened, late in that year for the Nifty 50. The problem is it was only 50 stocks from the likes of, Morgan Guarantee. And that's what we're seeing now. It's the Magnificent Seven, or the Nifty 7, if you want to call it that. So the problem with that is that's carried the equity indexes higher. And the danger is, if you're the Fed, you're looking at I think there's primary two things they're having trouble with. One, government largesse. Government spending is not backing off. It will not back off. It's politically popular. That's a big problem for the Fed. The second part is the weakest part of the economy historically would be low-end wages dropping off and getting hurt. That is not happening. Wages continue to outpunch inflation in general right now. And then if you look at the lowest wages, they've done the best for 2 years. That keeps the Fed stuck. I think those two things coalescing together is a bad cocktail. It will not cause a fun 2024 hangover.
Matt, do you believe that there's going to be some type of massive rotation that we see out of the Magnificent Seven? I mean, we've witnessed the climb over the course of this year. 7 stocks essentially in the S&P 500 that have garnered this much attention. And to Cole's point, if we are that much overweighted in those 7 stocks at this point, does it seem like there's some type of rug pull, or if generative AI doesn't pan out the way that many had invested in the thesis that it was just going to be passed through as another type of services margin part of the business, how does that impact these brands?
Well, I mean, one of the things that we have to be concerned about with this whole rotation idea, and it sounds good because when we do get a narrow market, a rather narrow market for a period of time, and it starts to broaden out, that's very, very bullish. However, when you get an incredibly narrow market, like we've had recently, and we had back in the early 1970s, we've had other times, whenever that takes place, at least over the last 40 years, the market never expands enough. I mean, you always see the ones that have really led the market higher, the small number of names, come back down. We never see the narrow market, the rest of the market play catch up. It's just the way it happens. The same thing is true when you get the market as expensive as it is now. Well, we all like to think that that the economy can play catch up, but usually what happens is that the best you can hope for is meeting somewhere in the middle, and more likely that the stock prices have to come back down. We are starting. The thing is, every single time we have this situation, it looks like the market can play catch up, and that's what we're seeing right now. But eventually, we get to the situation where we just can't get that kind of a catch up in the economy. And the one thing I really want to talk about is this whole thing with earnings. It's great to talk about. Hey, earnings were flat this year. All we had was multiple expansion. Okay. Well, earnings are expected to be up 12% next year. That's great, but that still leaves us on a very expensive side of the market. I mean, we're going to still be looking at 20 times earnings or higher. We're going to need a lot more than 12% increase in S&P earnings if this market's going to rally a lot more. And to be honest with you, I just don't see that right now. I don't want to be overly bearish here, but at the same time, we have to look at history, and it tells us a lot of things are happening right now, which are signals of tops. But because the market is rallying in a parabolic way, a lot of investors are ignoring that right now. And I think that's something they shouldn't really be doing.
Cole, another mantra we're focused on here at Yahoo Finance today, that is buy the rumor, sell the news. And that certainly seemed to do NVIDIA quite well this year. What happens to AI plays like NVIDIA next year? We get results that maybe aren't as robust as they were this year. Do you think we see sell-offs?
Yeah, I mean, the good thing for the stocks that have played that up is it's greatly grown their multiples. That's what they've done successfully. And as I think you watch executives sell their stock in the open market, I mean, that's played right into their hands. The flip side is you actually have to go out and do those things. And as we've learned in prior episodes of Euphoria like this on subjects in the past, is that can take a long time. I mean, just go back and look at what happened in the late 90s. I mean, you could pull up the Ciscos, the Oracles. Very few of them ended up ever going to new high prices after that. Microsoft obviously successfully did, but they had to go through a decade of hell to get there. What I think the real danger in buy the rumor, sell the news is it is highly likely that while we have retirees as excited about owning stocks as they've really ever been as a group of investors in stocks, it is likely the S&P might not make money over the next decade, including dividends. When I say likely, that's our bet. And the other thing that I would throw out is, in real terms, that's a nightmare for those retirees. That is the kind of world that people are not preparing for on this hype and excitement. And the question is stock market failure going to cause everyone to lose enthusiasm for stocks? And that is the real danger. I mean, if you're in the wealth management business, if you're in the stock picking business, if you're in the indexing business, that sucks. The question is, what are you doing differently? And I think the one thing is you can't play into that hype. That's the real danger.
And then just lastly, while we've got you guys here with us, Matt, sell in May, go away. Of course, a very popular adage year in, year out. How effective was that this year? I mean, you could see we gave it an F, but it also depends upon what time you came back in the market, perhaps. I want to get your perspective on this.
Well, yes, sell in May and go away obviously worked very poorly. It actually does work usually, and history shows that, but it obviously was a complete disaster this year. Part of that had to do with the influx of liquidity that the Fed pushed into the system because of the regional banking crisis, and the thing all exacerbated itself because we had the budget issues in June, and that made the supply demand of treasuries much different, and again that left a lot of liquidity in the marketplace that is still kind of sitting out there, and as that becomes less plentiful, it's going to be much tougher for the market to rally further. I mean, I think Cole is so right in so many different areas. I mean, and that's why I think that some of these calls recently we've heard around Wall Street that to go all in with stocks. I mean, what if we're wrong? Maybe the market does go up another 25%, but having some cash. If people say, "Oh, so and so missed the market," well, if you only have 5% cash or 10% cash or 15% cash, you don't miss the entire move. And besides, you are getting paid for some of that cash. And if we do see a deep correction or even just a mild correction, you'll have some money on the sidelines to put to use. So I just, people need to be very, very careful about this parabolic rally we've seen in the last couple of months and assume that's going to go continue throughout 2024.
All right, let's leave it there. Cole Smead and Matt Maley, good to see you both. Thanks for coming on throughout the year with really some great analysis. Really appreciate it.